Futures trading is becoming the new go-to for all Forex traders in the US, as prop firms are starting to lock out their clients for good. If you clicked on this video, you're probably in the same boat, or you're somebody new looking to get into futures. Either way, today's video is going to give you a step-by-step roadmap on how to transition to futures trading in 2024. For the beginners watching this, I'll try to keep this as straightforward as possible. My name is Justin Werlein, and I've been trading for around 5 years now. I've been trading futures for 3 years, and I'm almost at 7 figures in total profits in those 5 years. For the first 2 years of when I first started trading, I was introduced to options, which I guess a lot of you most likely know if you've been in the space for a little bit of time. I was on social media. I started to see a lot of people getting big percent returns with their contracts, and I was a little bit interested. After trading options for 2 years, I started to realize it was not what I wanted to trade. It was very hard for me to manage risk. You have to worry about the Greeks, theta, delta, gamma. You have to worry about all of these things that are actually affecting the premium of the contract. Now, when I found futures, I realized I didn't have to worry about that whatsoever. One of the biggest problems that I had when I was trading options was I was trading, 1 week out expirations, and I had to worry about time decay on my contracts, which meant I would enter a position, and while time went on, the premium of my contract would decrease without the market even doing anything. So I could be exactly at my entry point, but my premium would lose its value. So I would set a stop loss to a specific point on the chart, and by the time it got there, my risk was now more than what I eventually actually planned before I even entered the trade. Another problem of this is when you base a stop loss off of a percentage of the contract and not actually on the chart, you find yourself getting stopped out really early when the market doesn't even give you the chance to really recognize you should get out of the market. So a lot of the times you'll get stopped at, a 20% decrease of your contract, but the market never even invalidated the model or whatever trade that you're looking to take. Now, with futures, one of the biggest reasons I switched over is because I'm able to manage my risk so much more efficiently. Since futures are based off of a tick value, meaning that there's no time decay on the contracts, I could hold them for an entire day at one point in time and I couldn't lose money, I could make money, but if it's at that exact entry point, I will not lose or make any money. I'll be break even. And with options, with time decay, that's not the case. So with futures, I was able to manage my risk and actually set a defined risk before I even entered a trade, because I could calculate through the tick value exactly where my stop loss would be, exactly how many contracts I should put on, and I'll know exactly what I'm risking and exactly what my profit is before I even enter the trade, which is one of the most important things in trading. You have to have a plan before you enter the trade. You have to know your risk, and you have to know how much you're looking to reward. Another big benefit with futures is something called the 60-40 rule. Now, the 60-40 rule is a tax benefit that you get with trading futures, meaning 60% of the total profits that you have from futures is taxed with long-term capital gain, and 40% of the total profits is taxed with short-term capital gain. So instead with options, where you're taxed 100% of those profits on short-term capital gain, you're only taxed 60% of those profits with short-term capital gain with futures. Now, you might be saying, Justin, you're saying ticks, points. I want to talk a little bit more into that as well. Now, ticks and points are values on a chart that gives us an idea of the value of where the index is on a chart. For example, if we're talking about NASDAQ, it could be around 18,000 something. Now, depending on the future that you're trading, that future will move with a defined tick value. So when you're trading NQ and you buy one contract, 1 point move on NASDAQ is a $20 increase of that contract. So using a point in tick value system, it's super easy to be able to define your risk and figure out how much you're risking on the table and how much you're possibly going to be rewarded. Another thing that I love about futures instead of trading options through stocks is indice markets are much more fluent and much more volatile. Since there's more liquidity funneled into the indices, it's a lot cleaner moves and clear action, easier to read and easier to trade. Another thing that I love about futures is you're able to use indices together to find divergences in the market. When I trade, I use something called an SMT, which is a smart money technique, and a divergence between ES and NQ. I can look at these two correlating indices and find a divergence between the two and get a good understanding of where the indices are headed. This gives me an understanding of what the bias is, and then I can use that to frame a trade off of. Another thing about futures is it's all based off of margin. Now, margin might be a scary word. I'm sure you've heard it before, and everybody says, oh, never trade on margin, never trade on margin. Let me tell you the reality. Margin is not a bad thing at all. Most brokers nowadays won't even let you trade below your margin requirement, which means you'll never be able to owe more money than is in your account. With future contracts, you're not actually buying these contracts, you're using initial margin to borrow them. So what's happening is when you trade NASDAQ, one mini contract is $1,000 initial margin, meaning you have to have at least $1,000 in your account to be able to purchase one contract of NQ. Now there's also something called micros. There's minis and micros with futures. Micros are 1/10 the size of minis. So if you think one mini is too heavy size and you don't want to trade a $1,000 contract, you can trade a micro contract, which is only $100, which is 1/10 the size. I recommend using Tradovate, which is one of the easiest brokers to set up for trading futures. I personally use it with most of my live accounts. There's some other ones like EdgeClear, Thinkorswim. I would say Thinkorswim is one of the least better ones to trade just because the fees are more heavy on it. With futures as well, you're able to use funded accounts in prop firms to your advantage. Now, if you don't know what a prop firm is, they're firms that end up funding capital to new traders to then trade with to make their own money. So if you don't have much capital to start, you can end up paying a short evaluation fee to take an exam, pass that exam, and they'll fund you $50,000, $100,000, up to $300,000 in capital to actually trade with. And most of these prop firms use futures, so you're able to use futures and trade funded capital with them. So I want to dive in and show you guys how I actually calculate my risk when I'm trading futures. So just looking at a blank chart here, what I want to show you guys is on TradingView, you have this tool to the left, a long position and a short position. Now, since NQ and NASDAQ and other futures are based off of tick values, you're able to measure exactly how much you would be risking for a stop loss. Now, for example, if I was to take a long right here on NASDAQ, I was to put a stop loss at this recent low to the left, and let's say I want to be targeting this high to the left of us, right? These highs right here. I could put this on my chart and I can see, okay, I have a 2 risk to reward. And if I right click this and I click create limit order, if I'm trading one contract, I can see exactly how much my take profit would be and exactly how much my stop loss would be. And again, if let's say my max risk is $5,000. Now, most of you guys it's not, but let's just say it is. If my max loss is $5,000 for one trade, what I'll do is I'll adjust my size to figure out what my sizing should be based off of my max loss. So for example, in this case, I would trade 6 contracts because I'm risking around $5,000, and it's based off of the setup, which is most important. Your trade should be based off of the actual setup itself. Because with options, when you're basing your stop loss off of a 20% decrease of a contract premium, what's happening is you're trading off of the premium and not the actual chart itself, which is showing you the decision you should be making. When you're able to use these tools, you're able to have more consistent wins and more consistent losses, keeping them as small as possible because you know exactly your max risk before even entering the setup. If you guys are still confused about how this whole futures thing works, I don't blame you. It also took me a second to fully understand it. I highly recommend that you watch this just a couple times until it starts to click a little more. And if you want to learn my system for winning and how I make money in the futures market, I made a video about how I made $18,000 in one trade in just around 30 minutes. That I'll link down below in the description of this video. Thank you guys for tuning in, and I'll see you guys in the next one.